Well, here we are as we approach the end of 2025. Thanksgiving's right around the corner, and the economy seems like maybe it's outperformed compared to what some of our expectations were coming into this year. The stock market has had some new volatility that's been introduced. We've got tariff policies that have caused tremendous amounts of volatility in the market, and in some of the economic data, we're looking at government shutdowns that were just recently relaxed. People are focused on artificial intelligence. There's a lot going on right now. In today's episode of the First Trust ROI Podcast, I'm joined by senior economist Strider Elass to help me make sense of some of what's happening, especially with respect to the U.S. economy. Thanks for joining us on this episode of the First Trust ROI Podcast. So, Strider, this is, I think, the official first time that we've done the podcast virtually. And I'm not sure how I feel about it, to be honest. I really enjoy a face-to-face conversation, so we will definitely have you on again where we can do this face-to-face. But at the same time, you know, you're on the West Coast, I'm on the East Coast. In this particular instance, I was just glad to get you on the podcast. So forgive me for forcing this to be virtual, but we'll do it in person next time.
Oh, I'm so glad it worked out. It's great to be with you. I would rather be with you in person too. It's always fun, but virtual will do it.
We're recording this right before Thanksgiving. We've all got a lot to be thankful for. And we're also recording it post NVIDIA earnings, which, you know, it seems like Jensen Huang has a lot to be thankful for as well. Although we've had a lot of volatility. So I want to talk about a lot of the things that are happening around the world, including AI. But one of the things that just ended as we're recording this, maybe within the last week, was the government shutdown. And I've been wondering about this from an economist standpoint. How is this just one of those narratives that everyone thinks is bigger than it is? I know your data flow is less because of the government shutdown, but you know, how does that impact your ability as an economist to understand what's going on in the economy? Does it have a big impact or a small impact? Maybe you could talk about that for a moment.
Sure. Yeah. I mean, with the government shutdown, a lot of, obviously the government data stopped. The Fed was still providing some data. And then there's a lot of other private industries that provide data as well. So you can still get a general idea of where the economy is heading, where things are going. I would say if the government shutdown lasted 6 months or a year and we weren't getting any of that data, which everybody was so used to getting for years and years and years and years and years, that would start to put a wrench in things in a big way. But it made things a little bit more interesting, to say the least. But you can get a general idea of where things are. And now, since the government's reopened, we are starting to get some reports that weren't released that have just been released late, and some just won't even get released ever, which is kind of interesting in itself. But in terms of where the economy is today relative to where it was before the government shutdown, I don't think things look really too different from the data that we continue to get through the government shutdown and even some of the data that's come in since.
Yeah, it seems like the one thing that people were mainly talking about anyway was, you know, what the Fed was going to do without all this information that they were, you know, they're missing out on. And I think that even snuck into some of the market pricing for what the Fed was going to do with respect to rate cuts throughout this year. It seems like there has been, maybe a full cut taken out of what might happen between now and the end of next year. Do you have a sense of where the Fed is going? Are we still in a cutting cycle? And do you think it is likely that the Fed is going to turn more hawkish, or will they be as dovish as the market has priced in?
Yeah, I still believe we're in a rate cutting cycle for sure. Now, the question is, will the Fed cut in December or not? I'm starting to lean more towards they're not. The market as well is definitely leaning towards they're no longer going to cut in December, which is a dramatic change from just where things were a week or two ago. And I think it does make it a little bit harder. I mean, when Chairman Powell spoke at that last press conference, he made it clear that the room was pretty much split between whether it was a good idea to cut or not in December. And with the government shutdown, I think the stream of data, as we just talked about, was less. And so we're not getting a lot of the inflation reports that they're used to seeing, and we're not getting the employment reports like we were. And so they're going to have less data available to them for that December meeting. And I think if they do want to punt and push it into next year, they have enough arsenal to be able to do that, to say that, hey, we just are data dependent and we don't have enough data. We haven't been able to see enough that makes us feel comfortable that we need to cut. I generally think they should continue to be cutting here. I think on the employment side, especially, things are continuing to weaken. And yes, inflation's hovering around 3% and has ticked back up a little bit, but I don't believe that's going to last. I think we will continue to move closer towards 2% in the coming year.
Let's stay on that, the employment and the strength of the U.S. consumer for a minute. That's something that for those that don't know you, you're the author of the 3 on Thursday report that has become very, very popular at First Trust, where you take snapshots of 3 different data points and you kind of put them together and talk about the narrative that underlies that. And one of the recent ones you guys did was looking at household debt and credit. I was looking at that report, and it just seems like we are at an all-time high in the level of debt, but then again, it usually kind of climbs up and to the right. That's tends to be the pattern over many, many years. And I guess we're talking about interest rates. Is there a concern that rates are going to be too high for all those consumers that have a lot of debt, or is that something that is maybe overblown?
Yeah, so the 3 on Thursday is really fun to put together. It's a lot of just interesting information, and if anybody ever has ideas and they want to forward them along, I'm always happy to look at anything that's out there. But in terms of that specific report, it is true household debt sitting at record or pretty much close to record highs. And I think every year people use this as almost a crutch to say the economy's not in good shape. Look at households, because in 2007, 2008, we had a financial crisis and the consumer was over levered. But what I'd say is so different this time around is really, if you look at household debt, you take it back 100 years, almost every year, that measure is sitting at record highs. So just knowing the level of household debt doesn't really tell us too much. The only times it's really declining is during recessions or pretty much flat, and then it starts to move higher again after in the recovery. But so you need to compare it to something else. And usually when households are taking out debt, they're taking out debt to purchase assets. And when you look at household debt relative to assets, it was very true from 2000 really till about 2009. Household debt relative to assets was growing pretty rapidly, but it peaked around 2009, and since then it's actually plummeted. So household debt as a share of assets is actually sitting at some of the lowest shares that we have seen since the 1960s. So although debt's at record highs, assets have grown so much faster than overall household debt. And to me, that's a key point. But number two, what you're talking about with interest rates, I think is very important today, because interest rates have gone up a lot. But when you actually zoom into what household debt's actually made up of, about 70% of household debt is just in mortgages. And so in 2006, 2007, that was a huge issue, because about 40% of those mortgages outstanding were adjustable rates back then. And so people got into a lot of trouble. Inventory skyrocketed. Demand fell off a cliff. We had the housing collapse. But when you look at where things are today, with 70% of household debt in mortgages, of those mortgages outstanding, only about 4.8% of those mortgages are adjustable rate mortgages. 95.2% are fixed. And where it's even more interesting is, well, what are they actually fixed at? And we have about 27% of mortgages outstanding today that are fixed at less than 3% on either a 15-year or a 30-year. We have another about 31% that are fixed between 3 and 4%. So we have more than 50% of mortgages outstanding that are actually fixed at less than 4%. I look at that as a huge, huge benefit to households. And by far the biggest debt that most households have is that mortgage. And the fact that the average interest rate outstanding on that debt across all mortgages is 4.3%, is amazing to me. And it's something that I think is a massive benefit to households here.
Yeah, and that's also probably the reason why there's some weird dynamics that have happened with the housing market, because nobody wants to refinance that really advantageous mortgage rate and when they have to buy a new home and pay 6-7%. And so that has an impact on the level of supply that's hitting the market, right?
Oh, yeah, definitely. I think a lot of people have kind of scratched their heads over the last couple of years and thought, well, demand's fallen off a cliff. Why aren't home prices nationwide just collapsing? And I think a lot of people are still worried that that's to come. And home prices nationwide are pretty much flat. They're up maybe maybe 1.5% year over year. So nothing really to write home about, but they're not collapsing. And I think moving forward over the next couple of years, they won't collapse either, because yes, although demand's very, very low, as you just said, supply is very, very low. People aren't willing to put their homes on the market to buy an equivalent priced home where all of a sudden they might be paying double or triple that mortgage payment that they're originally paying. It just does not make sense. And so no matter if people are happy with their current home or not, what they are very happy with is the unbelievably low interest rates that maybe might be once in a lifetime type of a deal that they have in place that they're not willing to give up whatsoever.
Another interesting chart on that same report where you looked at delinquency rates, especially the one that I found really interesting was delinquency rates for student loan debt. And that's another weird dynamic, because we went through COVID where the government essentially paused people's payments. They said you don't have to make payments on your student loan debt. So there were no delinquencies. And then more recently, the chart shows that it surged. So what do you what's behind that? What's going on there?
Yeah, I think really what happened was during COVID, especially when it was completely paused and people thought maybe we'll get these actually forgiven by the government, that they weren't paying them, and they weren't paying them for a couple of years, and then they were supposed to start paying them, and the government said, well, we're going to give you another year of leniency where you're not going to technically be in default, but we'd like it if you start paying us, but if you don't, it's not a big deal. And people decided to still not pay those back. And I think what's happened is people, especially with all the inflation that we've seen, people just got very comfortable not making those payments anymore. And in fact, started to spend that money that they'd be putting away to make those payments. And so when eventually this came due, all of a sudden what we saw was a massive spike in defaults. And in fact, if you look at those loans that are 90 days plus delinquent, they've skyrocketed to about 14%, which is the highest that we've seen really going back in history for student loans to at least 2000. But what's interesting is you can break it out by, you can break it out by age as well. And it's really those that are 50 years and older that are really struggling with delinquencies right now, that are 90 days plus delinquent. And that level is almost around 20% of loans outstanding that are delinquent 90 days plus right now.
So 50 years and older, that means that, maybe all those people didn't graduate when they were 22 or something like that. And maybe there's some grad school debt and some, doctoral work or something like that. But if you're just talking about undergrad debt, if you're over 50, you've had that debt outstanding for 30 years. Is there a big chunk of people that are 50 plus that still have college loans?
I guess so. I haven't dug through the exact numbers of them, and I'm not sure if we can actually get that number from the Fed. But it's pretty eye-opening. I think that it's that category of everybody that's the most delinquent right now.
Okay, so I want to pivot a little bit towards one of the things that has been talked about all year, and that is tariffs. We've had a lot of discussions on the podcast about tariffs, on the news cycle. Tariffs have come and gone and come and gone and come and gone. As the discussion on tariffs has evolved this year, it seems to me that the Trump administration seems like it's become more and more kind of all in. Like they've pushed the chips in. Early on, it seemed like the rationale for tariffs was that We were going to equalize the playing field with trading partners. And my optimistic take was maybe that this would be a tool that could be used to put tariffs on, so everyone says, okay, we're going to eliminate tariffs. But the rhetoric doesn't seem to favor my optimistic view. Maybe I'm wrong on that, but I'm curious what your take is. What's the ultimate goal here? And what's the impact been, and any, I don't know, what's your outlook going forward?
Yeah, I think the thing that Trump and I have most in common more than anything else is that we both just don't know what he's going to do tomorrow. So I wish I knew what the ultimate outcome was going to be, but I don't. But I will give you kind of my thoughts on where things are. I completely agree with you in the sense that I believe, too, when he came into office this time around, that he was going to use the same kind of tactics that he used when he was president the first time around. And really those tactics were, look, you look at all of our biggest trading partners, every single one of you charges higher tariffs on goods coming into your country on average than we do on goods coming into our country. So either you lower your tariffs to get more in line with us, or we're going to raise our tariffs to get more in line with you. And that's the rhetoric that he used when he was president the first time around. And what he did, raising tariffs the first time around, I don't agree with higher tariffs. But did it work? Yeah, you look at all of our major trading partners, and every single one of them has lower tariffs on average in place today than where they were when President Trump became president in 2016. And so when you think about it from that point of view, I would say, okay, he was going to do the exact same thing this time around. And if he didn't put that pressure on, tariffs would have been higher across the world for sure. So we come into this presidency and it seems like that's what he's doing. But I think pretty quickly, once he started to raise tariffs, he realized, wow, this can actually be quite a big revenue generator for the United States. And I think the way he looks at it is, hey, or the way it's portrayed to the public is, look, it's not U.S. companies, it's not U.S. citizens that are going to be paying these tariffs. It's the countries. China's paying this tariff, or Taiwan's paying this tariff, or Italy, whatever country it is, they're the ones who are paying the tariff. But the reality is, no, it falls majority of it falls on the U.S. Companies or U.S. consumers, that it's passed on through the companies. And just to give you an idea of where things are today and why this has been such a good revenue generator is, if you look at our effective tariff rate in 2024, it was 2.3%. So that means, and that's across all countries. So that means if you imported something on average for $1, you paid $1.02 to get that into the United States. Well, today that effective tariff rate's moved up to 9.8%. So instead of $1.02 to get it into the United States, you now have to pay $1.10. But across all of our trading partners, it looks very different. So for instance, looking at China, which we know is a big importer, they're now the third biggest importer into the United States. They used to be number one, and then they moved down to 2, and now they're down to 3. And a big reason is because of how large the tariffs are in the United States that are being put on Chinese goods. Last year in 2024, it was 11%. So $1 worth of goods that was purchased would cost $1.11 to get into the United States. Well, now it's up to 40%. So that's gone from $1.11 to $1.40, and that's across all goods from China. So that's that's the actual effective tariff rate that we're seeing on goods coming in. I mean, that's high. Now, some companies have been able to absorb that. Other companies are passing it on. But I think the bigger issue, and that's not talked about near enough, is really the uncertainty around the tariffs. I've got 4 kids, as I know you. Do you have 4 or 5? I can't remember. 4. Yeah, we both have 4 kids, so we're doing our part, right? We're contributing to society. 4 kids is a lot. But my 2 oldest, I have a 9-year-old and a 7-year-old. They love to play the game Candyland. And every weekend we pull out the Candyland board. If you don't remember, pretty simple little board like this. All you do is you flip over a card. It either has 1 color on it, it's got 2 colors on it, or it's got a character, and you just do whatever the card tells you to do. Well, my oldest, she is very rules oriented. She would never cheat or break the rules. Even if she's losing, doesn't matter. My second oldest, now she's she likes to if she's not winning, she figures out a way to win. And, so the rules start to change pretty quickly. She might turn over a card. She doesn't like it. She'll turn over another one. We say, hey, you can't do that. Well, she just keeps doing it. And anyway, the game gets so frustrating that we quit almost every time. If she's losing, we just quit because she changes the rules all the time. It's no fun. Anyway, somehow we keep playing that game every single week. But the point of that is that if the rules are constantly changing, you just can't play the game. And it doesn't matter if the rules are good or bad. I mean, you obviously want good rules, not bad rules. But as long as the rules are consistent and people are able to play by those rules, then you can play the game. And the way that I look at the economy today, especially for small and medium-sized businesses, is that they're not looking for the next month for production. They're looking out 3, 6, 9 months out right now for what they need to be bringing into the United States. And they don't have the luxuries like a lot of larger companies where they can switch manufacturing to different countries, so on and so forth. And so if they don't know whether the tariffs from China, let's just say, are going to be 40% 3 months from now, or if they're going to be 80%, or if they're going to be 20% or 150%, and they're trying to make decisions 3, 6 months out today because it takes months for that stuff to be produced and then another month for it to be shipped over on the sea, it makes it very hard to be able to run a business. And so I think no matter what happens with the tariffs, are they hurting the economy? I'd say, yeah, they are hurting the economy. Is it enough to take us into a recession? No. But I think what's hurting the economy more is really the uncertainty around the tariffs. And so what I hope is that at some point here, hopefully in the near future, we just get certainty on where these tariff rates are going to stay and where they're going to be for the foreseeable future.
Does that need to be, this may be a question for Bob Stein, but is that something that has to be passed into legislation for it to be more permanent? Or is this, because it seems like, some of the ways that tariffs have been introduced and put on to trading partners, it's kind of executive order, but that doesn't tend to be permanent. That tends to be, the next guy could come and take it away, and maybe the courts will take it away. But it does seem that the Trump administration wants to make a lot of these tariffs and the policies to be permanent, right?
And that actually would be a great question for Bob. I don't know whether or not they can be permanent, but I think they could be at least permanent for the next couple of years under President Trump. And that alone, I think, would be helpful to just have some certainty. Right now, it's day to day, right? Like, think about just a couple of weeks ago where the president was threatening on putting an extra 100% on China in terms of already the onerous tariffs that are there. So that's what's concerning to me. But I do believe that a lot of these tariffs that are in place, that have been put in place for national security purposes by the president, that really have no reason, there's no national security threat, will be removed. I think the Supreme Court will vote just like every other court has voted so far that they're just not constitutional. But with that, I mean, the Trump administration is very, very smart. They've had lots of time to prepare for this. And so they already have other ways to implement tariffs in the wings. So although we might see a little bit of tariff relief, I think it's still going to be a lot higher than what most people expect.
I think maybe the tool to win public sentiment is what the president introduced maybe last week or the week before, the concept of paying everyone $2,000 in revenue that is said to have come from tariff revenue. And $2,000, I don't know how many taxpayers that actually would impact, but that's a substantial amount of money that you're handing out.
Yeah, it is. And the reality is it wouldn't go to every taxpayer, that's for sure. But if you look at how much has been brought in so far in revenues for this year through customs duties, it's about $240 billion. We're probably going to be close to, when all said and done for the year, around $300 billion in customs duties for 2025. That's up from about $100 billion in 2024. And if the tariffs, the way they are, stay in place, you could bring in about $350 billion a year in customs duties. But the reality is, who's paying those customs duties? And at the end of the day, it is the American citizen or the American company that's really paying those taxes.
One of the objectives, I think, of tariffs, at least one of the stated objectives, and it becomes more difficult because of the sort of transitory nature of some of these tariffs, as we've been discussing, but is to bring manufacturing onshore, to incentivize semiconductor fabs to be built in the U.S. The Biden administration also wanted the same thing, but their tool was, we're going to introduce these spending plans like the CHIPS Act, and that's how we're going to incentivize building these semiconductor fabs. Trump says, we don't want to do that. We want to do it through tariffs. And so it's just a different set of incentives. But either way, it seems like there's a lot of semiconductor plants that are either in the early planning stages or, well underway in terms of construction. Is that something that you think is going to continue for the next several years, or is this a shorter term phenomenon?
No, I think it's going to be going on for quite some time. I do believe we're going to continue to see more and more manufacturing coming back to the United States, but it's really going to be more kind of semiconductors, those type of things, high-tech manufacturing that will be in the United States. It makes no sense to bring textile manufacturing back to the United States, shoes, clothing. Those are very labor intensive, and it doesn't make sense. And so most of the factories that will be built will be very high-tech factories that are run by very few people, but mostly robotics and other machinery that is very, very high-tech. And to give you an idea, though, in the United States, well, first off, the United States is still the world's second largest manufacturer, which I think a lot of people forget. And it goes China, which they surpassed us, I think it was back in 2013, is becoming the world's largest manufacturer. And then it's the United States. And then there's a massive drop before you get to number 3 for manufacturing. But when you look specifically at semiconductors, I think another thing that's pretty interesting too is that in the United States today, we have 95 semiconductor fabrication plants currently. And the only country that has more semi plants than us is Japan. Japan has 103 of them. And the difference, though, in the United States is so many of our fab plants are basically built for research and development. We're the ones who are really creating the way that chips need to be manufactured and built. And so you look at a country like Taiwan, why it's so important. Although Taiwan only has 80 fab plants, they're all built for high manufacturing capacity of chips and wafers. And so Taiwan itself, and why it's so important to the world, is 68% of all semiconductor output goes through Taiwan, comes out of Taiwan. That is a national security issue. And so for that reason alone, I think we will continue to see more and more semiconductors plants, especially being built in the United States. And the CHIPS Act did have a meaningful impact on that. I think about $53 billion worth of the CHIPS Act went directly to these new semi plants that are being built. But it wasn't just that. There's been another $600 billion since 2020 that's gone into manufacturing of semiconductor plants, which is a massive amount of investment. And currently there's about 22 plants that are either under construction in the United States or being planned. So I still think we're in the early stages of this, and this is something that's going to continue for whether there's subsidies for it or not. I think it's something that is in high demand, and that's not going to go away anytime soon.
It has been interesting because, my hometown of Syracuse, New York, Micron announced, I believe it was in 2022, that they were going to spend somewhere around $100 billion to build 4 chip fabs between maybe now and 2040, I think. Anyways, so here we are 3 years later, and they have yet to break ground. And some of that has to do with environmental regulation. Some of it has to do with the migratory pattern of an endangered species of bats that are, there's like 20 million acres of habitable land for bats in New York State, but they're really focused on the, 500 acres that Micron would have to clear. Regardless, they haven't broken ground yet, but it seems like it's a multi-year process once they do. I just wonder, it seems like you've got to make the regulatory efficiency better. And And, I know the Trump administration has only been in office for less than a year now, but you would think that that would be really on high on their list of priorities. I know they've focused on curtailing regulations in a lot of ways, but it seems like with some of these really these building projects that have national security implications, that they'd really want to make ways for that to move along more quickly.
Yeah, I don't disagree. And I think cutting regulation is one of the administration's biggest goals over the 4 years. And I think they've already done a fair amount of cutting red tape, but there is a lot of red tape that needs to be cut. I mean, we're across the board, anything to do with construction in any state, it seems like, is very slow because of all of the red tape that's involved. And I think, yes, obviously some of that is needed because we want safety regulations and whatnot, but a lot of it, I think, could be fixed and just done away with.
That brings to mind DOGE. Remember DOGE? It seems like that was a big priority for a while, but I haven't heard much about DOGE lately. The Department of Government Efficiency, the Trump administration was going to come in, they were going to make some cuts to programs and make things more efficient. And it's really tough you heard a lot of things that were being cut, but I think the normal person every day doesn't really see it unless you're living in Virginia or maybe around DC. Do you have any sense on where DOGE is today?
Yeah, I was so excited when the president was elected, for the biggest reason that I really thought that we were going to see some pretty sizable changes to the size of government. And the Department of Government Efficiency got put in place, and Elon Musk was running it. And we know anything that Elon Musk touches, he's able to accomplish even the impossible. I mean, everything he's done, he's taken that which is impossible and he's made it a reality. And so I thought, government, trying to shrink the size of government, that's an impossibility. But we have Elon Musk and maybe he's going to be able to do it. Well, it turns out that even for Elon Musk, I guess it was just too big of a task. And when you look at what's really going on with the Department of Government Efficiency, what they're actually able to cut on their own without Congress, it's just really not that significant. Any cuts to government are great. And I think they've done, they've been making some cuts, but the reality is that majority of government spending is really mandatory spending that goes out to individuals. It's transfer payments to individuals. And when you look at Social Security, Medicare, Medicaid, you look at other mandatory spending, really about 87% of government spending, you could technically say it's not really mandatory, but you could technically almost put it in to the mandatory category if you include defense spending in there and you include net interest payments as well. And so that really only leaves about 13% that's non-defense discretionary spending. And even if you cut all of that spending tomorrow, so it's close to $1 trillion. Let's just say you cut all that spending tomorrow. It's less than $1 trillion, but around there. Even if you cut all that tomorrow, within 4 years, all those other mandatory programs that have automatic growth rates to them will surpass all of that savings. So the reality is, if you ever want to get government spending under control or even slow the growth rate of government spending, which that in itself makes a huge difference, I think you do need to start to go into some of these mandatory programs and figure out ways to make them a lot more efficient, get rid of the fraud and abuse. And I think that's something that the Department of Government Efficiency has looked into and could do. But the issue is that you need Congress to sign off on majority of that. And to get anything through Congress these days just seems like a big uphill battle. The same thing kind of happened back in the 1980s too with President Reagan. He wanted to cut government spending as well. And so he put together a commission. It was called the Grace Commission because it was headed by a guy named Peter Grace. And Peter Grace was a big fiscal conservative, CEO of W.R. Grace. And he, for 18 months, along with 160 other business executives, got together and combed through government spending. And at the end of it, they put together an actual book. It was called the Grace Commission Report. They gave it to Congress and anybody else that wanted to look through it. and they found about $425 billion that they believed over the next 3 years, if they cut that $423 billion, that by the year 2000, our debt outstanding would be about $1 trillion. And they said, if we don't do this, though, by the year 2000, we think debt's going to be more around 11 to 12 trillion dollars. And so Congress took all this information and they said, oh my goodness, this is unbelievable work. I mean, you guys put your heart and soul into this. And what did they do? Basically nothing, no cuts. And so here we sit today, kind of in the same situation, but about $38 trillion in debt, running $2 trillion deficits. And I don't think Congress is going to act any differently this time around, unfortunately.
You know, I suppose one of the optimistic takes that could happen with respect to kind of how to get out of the large amounts of debt would be to grow the economy. I mean, that would be maybe the most plausible way if you were able to use things like artificial intelligence or technology to be able to grow the economy. Maybe that makes the share of debt a little bit smaller than it might otherwise be. Maybe that raises tax revenue. Maybe that's overly optimistic, but I do want to talk a little bit about AI because that's what everyone's talking about. So am I painting just a pie in the sky picture? Is AI, does it have the capability, does technology have the capability of helping to grow our way out of some of the debt problems we have?
I think it definitely will over time, but I think just to go back first to your previous point, I'd say the issue is not so much the debt side of it that I'm concerned about. It's why we continue to accumulate all of this debt. And it's because we're spending so much more money than we're bringing in. And so many say, well, why don't we just raise more revenues? Why don't we have the rich pay their fair share? But the reality is that if you look back over time, it doesn't matter what you've taxed people. We've seen marginal rates in the 90s. We've seen them in the 30s. Revenues as a share of the economy, as a share of GDP, come in right around 17.5%, all the way back to 1950. Kind of bounces around, but if you went from 0 to 100 on a line, it looks just like a flat line at about 17.5%. Now, the problem is that on average, since 1950, we've been spending about 20% of GDP for government. And so that's why we always have a deficit. But the problem today, and really, if you look over the last 15 years, very rarely has government spending even gotten close to 20% of GDP. Not below it, just even close to it. It's been far, far, far above that. In fact, today it's still sitting around 24% of GDP. But you take a look at revenues today, revenues are sitting right at 17.5%, or basically where they need to be. And so to me, the issue's on the spending side. And as you said, with AI and whatnot, maybe that does cause us to grow faster in the future. And so let's say nominal growth right now, let's just say it's between 5 and 6%. If you can get government spending, you can still grow government spending, but you just need to grow spending slower than nominal GDP. And that means that spending as a share of the economy will start to come down. And the problem is that for really the last 15 years or so, very rarely have we had government spending growing at a rate that was even close to how fast the economy is growing. It's been growing well above that. And that to me is the big concern. But looking at AI in general, I mean, I think it will have dramatic impacts on the economy, especially obviously from an investment standpoint. Already it's having an incredibly meaningful impact on the economy. If you look just over the first 2 quarters of this year at GDP, at real GDP growth, business investment, but specifically business investment just in equipment and software has grown. Has contributed to real GDP growth as much as consumption has. Now, what's unique about that is consumption makes up 70% of GDP in the calculation. This subcomponent of equipment and software spending basically makes up 4%, and yet it contributed the exact same to growth as consumption did. That's amazing to me, and just shows you how much investment is going into AI right now. I believe where we are in the situation today with AI and where we are in the markets really can be summed up, pretty clearly by a guy named Roy Amara. And Roy Amara, he passed away in 2007, but he was a researcher, an unbelievably bright guy, a futurist, just some really interesting information. But he coined this phrase, I think it was back in the 1970s, where he said, we tend to overestimate the effect of tech in the short run, but underestimate it in the long run. And he calls it Amara's Law. And the reality is, I mean, this is back in the 70s that he coined that. But I think we go through these stages. And AI, there's no doubt that AI is going to be, it already has been, but I think in the future, just absolutely game-changing for every single industry. I think we will see massive productivity gains, but it's not going to be tomorrow. I think it's going to take at least 5, 10, 15 years for people to really be able to realize the gains from this. So in the short run, just as Amara says, we tend to overestimate the effects of new technologies. And when I look at the stock market today, especially from a market cap driven perspective, it just seems like things have gotten far too ahead of themselves by almost any metric that you look at. But I do believe the way that we think is in a linear fashion. It's very hard for us to understand exponential growth and in a big way, looking out especially over the future. And so that's why I think Amara's also correct that we tend to underestimate the future, how good technology will be. And with artificial intelligence especially, as knowledge continues to build on itself like never before, I think the future is just unbelievably bright.
I think that's a good way to look at it. Someday we need to have some sort of a like Strider's law. And what do you need to be an economist and get your own law? Is that like, do you make it up yourself and just put your name on it?
That's exactly. You just make it up yourself and call it after you, and you hope it catches on.
Okay, so that's actually that's one of the things I was going to ask you about is what's on the one hand, what do you think are risks to the economy that most people are overlooking, and then I want you to offset that with maybe what makes you optimistic about the economy. And I think you kind of laid out a case right there for optimism. Is there anything that you kind of think is under the radar that people should be paying attention to that's a bit more risky that maybe they're ignoring at this point?
Yeah, that's a great question. I mean, to me, the biggest risk still is just the size of government. I think something really does need to be done about just how big governments become, because it is unsustainable. Maybe it's sustainable for a couple of years, but it's really not sustainable to continue to be this size or bigger for the foreseeable future. And to me, that's the biggest concern. And I was hopeful that this administration was going to take it in the opposite direction. And we've seen a little bit of progress, so I do give them credit, but it's just, there's a lot further that we need to go in that direction. The other thing I'd say is looking at interest rates in general. I think a lot of people are shielded, as I said, especially on the middle income scale, where their biggest asset is a home, and they have a mortgage and they're locked in at this very low interest rate. But I just am a little still concerned about the commercial side of things, especially office buildings. We all know that that's been a huge issue, and many of those loans are continuing to come due, and they get kicked down. The can just keeps getting kicked down the road. But the reality is that they can't refinance these because they're worth 30 to 50% less than when they were purchased, and they have occupancy rates that aren't even close to where they were pre-COVID. And so that falls specifically on small and medium-sized banks in a big way. They own the majority of commercial lending. And so to me, that's something that I just think is worth continuing to keep an eye on. I know people believe that if the Fed continues to cut, that means that interest rates are coming down, which is true. But again, we just don't know if the Fed is going to continue to cut in a meaningful fashion when they believe that we're getting close to neutral here at some point.
I try to end the podcast episodes with the same question, especially for someone who's joining me for the first time. And that is there anything that you've read recently? I'm looking mainly for book recommendations. And, if you want to give me an economics book recommendation, that's fine. But really, I'm trying to figure out what else are you reading? Is there anything that you've read recently or that's on your reading list that you would recommend viewers and listeners of the ROI podcast to check out?
Yeah, I'd say, let's see here. I think the first one that I'm still reading it right now, but it's called Chip War, and it's written by a guy named Chris Miller, and it's all about semiconductors and really the whole history of semis. It's a very, very fascinating book. It's not dense. It's a real easy read, and it's very entertaining and just amazing to see how things have gone through progression, where it started, everything. So I would definitely recommend that book. I think it's been a fun read. And again, I'm not all the way through it, but so far so good. The other one I'd say that I'd recommend that I finished a little while ago was a book that was called, The Anxious Generation. And that was written by a guy named Jonathan Haidt. And The Anxious Generation is really a data-driven book about, I have 4 kids, as you have 4 kids. My kids are 9 and under. And it's really about social media and smartphones and how really when those came on board. I think the smartphone is one of the most amazing pieces of technology that's ever been created because it allows us to consume information like never before. But at the same time, there's been a lot of negatives that have come about too, especially for the younger generation with depression and anxiety and all these other issues that have really been driven from the phone, and the lack of research that's been done in a big way on this is kind of mind blowing. But he's been able to compile everything that's out there, and what he's found is that, yes, phones have a massive impact on your child's ability to function and even to their minds to be able to grow. And so I think I couldn't recommend it enough for really anybody to read, because I think it's pretty eye-opening. I know it was extremely eye-opening for me. Something I was already concerned about, I'm even more concerned about. But what I love about it is he gives really concrete steps too, that if this is something that worries you, how you can go about trying to fix this in your family or your child's life to help make them a better citizen as time goes.
I think that's a really great recommendation. That's one that I have read as well. And there's a lot of great advice, not least of which is let your kids be kids and let them play. And he recommends the concept of free range kids, where you don't have to be a helicopter parent all the time. And I think there's some truth to that as well. I certainly remember when I was a kid, we just head out, and I think everyone who's about my age, the parents got together and said, okay, just tell the kids to be home when the streetlights come on.
Yeah, exactly right. I missed that. And it's a great book. Really good book.
All right. Well, great. Appreciate that recommendation, Strider. Thanks for coming on the podcast. Hopefully next time we can do this in person, but do appreciate you joining us.
It was such a pleasure to be with you, Ryan. Hope we can do this again soon.
And thanks to all of you as well for joining us on this episode of the First Trust ROI podcast. We'll see you next time.